visit. So I want to welcome to the screen David Leiter, fellow member David Leiter. David is KPMG managing partner, head of the Atlanta office, as well as the Mid-South Hub. Does a lot of work in our community with the Metro Chamber, the Woodruff Arts Center, and many other things. So David, I want to turn it over to you to introduce the innovation team to talk about cryptocurrencies. And can they answer, what is Dogecoin?
Yeah, no, thank you, Cannon, so much. And hello, good afternoon, fellow Rotarians. I also hope everyone, like I did, had a terrific Mother's Day weekend. And it was so great to hear from President Zach, as my mother is an Agnes Scott alum. And so it's great to be with her and our extended family yesterday. So I'd also like to give thanks to Bill Hennigan for inviting us back to present on blockchain and cryptocurrency. As we discussed when we came to present back in March, we led a discussion on 5G, Internet of Things, and private networks. Atlanta has become a hot city for tech expansion. We've seen headlines recently, Microsoft, Apple, Facebook, many others have decided to invest in our city. And back in 2017, before it was cool to invest in technology in Atlanta, KPMG opened up its Ignition Center in Midtown. And it's one of 5 across the country. So it's a special asset that we have here in our great city. And it's where KPMG has about 300 data scientists working on extreme automation projects for our clients, working with them to help them use the leading edge technologies to reduce costs, improve quality, and unlock value. And so I'm excited about today's discussion and the KPMGers we've brought here today to have that discussion with you. And they will do a much better job than Lloyd Ostertag did. We hope that you'll leave today with a much clearer understanding of blockchain and cryptocurrency. And in a moment, I'm going to hand it over to David Jarczyk, one of my partners. But let me just run through a couple of introductions quickly about the KPMG panel today. So Luciana Valencia is a senior associate in our blockchain and crypto asset services practice. She manages our development operations, consults with our clients around the globe, advising them on their blockchain adoption strategy and supporting crypto asset custody, design, and implementations. And then Shantel Cannon is also a senior associate on our crypto asset services team. Within this team, she provides consulting services to crypto-focused companies and global financial institutions, helping them develop and implement crypto asset programs that meet operational risk and compliance requirements necessary for successful product offerings. And then finally, my partner and friend from Chicago, I was actually part of the KPMG team to help recruit and onboard David to the firm during my time in Chicago. But he is a national partner in our innovation group. And in this role, he leads the development of new services, solutions, and technologies for clients. And prior to joining KPMG, David founded and sold a consulting firm as well as a data technology company. And so before I hand it over to David, I just want to let all of you know that about 2.5 years or so ago, I went to David and I said, David, I need to understand blockchain. And in 10 minutes, he had me understanding it. So what I'd like to offer to everyone in the meeting today is if after today's discussion, you feel like you're not where you want to be with blockchain, please reach out. We can help you understand. So with that, I'd like to turn it over to David.
Thank you. Thank you very much, David Leiter. I appreciate that. And to everybody, hello. It's good to be with you. One of the benefits is of us being at home or being elsewhere is that we have technology to bring everyone together. So it's a pleasure to be here. You know, it's funny. I actually got to spend Mother's Day alone, but the day before with my mother on Saturday. So we watched that skit together, and she actually looked at me and said, I still don't get it. So basically, if you can't explain it to your mother, you can't explain it to anyone, right? Is the old saying. So we'll see if this works, because we went through this presentation a bit with her. So maybe if we can start with the slides here. Let's take a look at what we're talking about. Now, you'll notice the first piece, crypto and blockchain. It's very important to understand that there's actually two pieces here. And when we go into the outline, which is our next slide, please, you'll see how we break that up. Blockchain is a technology. It's a technology that allows us to do numerous things, and we're going to learn about that here in a moment. But most importantly, it's a technology that allows unrelated parties to speak to each other or work together. Crypto is a actual asset or a tool that works on blockchain. So blockchain can do many different things. Crypto is just one use case. And then crypto has many use cases as well. So as you can see here, we'll take you through those, blockchain, crypto, and then we'll talk a little bit about some risks and infrastructures, and then we'll answer all those questions that you may have from there. Next slide, please. So on the next slide, what you'll see is an introduction to blockchain. And if you're going to think about it in any way, shape, or form, please think about it this way. Today, on the bottom right, you have a buyer and a seller of, let's say, a home. What happens? I just recently went through this. You have your lawyers, you have your brokers, your insurance companies, and God knows how many different forms and how many different signings and how many different levels of effort that go into buying and selling a home. Okay. What happens is you've got these folks in the middle who do a bang-up job being decentralized entities who help that one transaction take place. But maybe there's another way that transaction can take place. What if the buyer and the seller and the lawyer and the banks or the lenders all had a system that connected with each other and allowed certain rules to be applied and certain actions to take place within law, within reason, within agreed upon reason? That's what blockchain is. It's effectively a system in which all transactions occur and they're kept on all the parties' different servers or computers. Why is that important? Well, if implemented correctly, it eliminates the need for those middle intermediaries, such as the banks and the brokers, who are now those trusted parties. So it's a very powerful technology that can be utilized both in a private environment for just an enterprise, as well as a public environment, which we'll talk about here in a moment. Next slide, please. Luciana, please.
Yes. Hi, great to meet everyone here. So as David Jarczyk had mentioned towards the end of that slide, is that blockchain can be implemented in two different ways. It could either be private permissioned or public permissionless. Private permission being more of the infrastructure or the implementation model for enterprise blockchain, so for your businesses. And public permissionless being more of the how cryptocurrencies such as Bitcoin are implemented. So a few differentiating factors of the two that I wanted to walk you all through is that private permissioned authorization is required to join and interact on the blockchain. There is a governance structure, and all transactions are private, access is restricted, and so you know everybody who is within the network. Whereas for public permissionless models, no authorization is required to join and interact in the blockchain. So as you see, anyone can invest in Bitcoin, so anyone can join that network. It's a truly decentralized model. Transactions are public. Anyone is open to read and write, and anyone can join. So some of the advantages and disadvantages of the two different models could include that within private permission, because it's a smaller network, it's faster transaction speed and it's more scalable. Whereas in public permissions, it's a bit slower and it's harder to scale. However, you would have full visibility and capability across all users in public networks, because within private permissioned, visibility and capabilities across users is controlled. Next slide, please. So as I mentioned previously, a lot of your crypto is found within the public network. So as an introduction to what really cryptocurrency is, it's really a form of payment that can be exchanged for exchanged online for goods and services. And how, so as David Jarczyk was alluding to it towards the beginning of the presentation, is that cryptocurrency and blockchain are separate, but they work together. So cryptocurrency depends on blockchain in order to function. And by using blockchain technology, it enables its distributed and decentralized quality. So blockchain, in other words, facilitates that transfer of currency from one individual to another in a completely decentralized fashion where there's no central authority entity controls either the production of blocks within the blockchain or is involved within its transfer. I wanted to walk you briefly through at a high level at how cryptocurrency works, but before I walk you through that process, I wanted to share with you what's important to understand is that as the name implies, blockchain is a chain of blocks, and each block contains a unique set of information or transactions. It also has a hash, which is, think of it as a unique identifier or a fingerprint or DNA that identifies that specific block and all the contents that's within it. And then additionally, each block has a copy of that code or hash of the previous block. And that's essentially what creates the link between all the blocks within that chain. And really, this enables the security around blockchain because any changes, no matter how big or small, within any transaction, within any particular block, will create that hash or that unique identifier to change. And that makes the chain unlink, and it'll be easy for the network to identify and detect where those changes have occurred. Whether those intentions or changes were malicious or not, it just makes, because of the distributed network and the visibility across the network, you're able to quickly identify where any changes have occurred and address it appropriately. So at a higher level, as soon as once a transaction is initiated, it is posted within, and I use a technical term here, my apologies, a mempool, which is really just think about it as a waiting room until transactions are confirmed and get posted in the block. So as it's within that waiting room, specific users of the blockchain called miners really solve a cryptographic puzzle or a math problem, if you will, using software to confirm the transaction. And once it's confirmed, it gets added to a block. What incentivizes miners to do all of this work is that the first one to solve this problem gets rewarded that cryptocurrency. However, what's important to understand is that what's required before transactions get posted on a block is consensus. And what this is that this means that the majority of the miners working within this network need to submit the same transaction data, or at least have the same answer to that math problem, in order to reach consensus and validate that that transaction is correct and can get posted on the network. Once consensus is reached, transactions are added to a block, and that gets linked to the chain by having that copy of the hash or the unique identifier of the previous block, as I mentioned before. So I hope this helps you understand a little bit more about what cryptocurrency is, how it differentiates from blockchain and how they work together, and overall what's occurring within a network that really helps this work and the security around it. With that, I'll hand it off to Shay to really share with you more insights as to the current state of crypto within the market. Next slide,
Great.
please.
Thank you so much, Luciana and David. We're going to talk current state, but I feel like maybe now is a good time to talk about the history, because this is a story that you've all been hearing in bits and pieces. You hear things like the invention of Bitcoin or Silk Road, or maybe like what does it mean that Coinbase has done an IPO? Like what is the relevance? So let's kind of take it from the beginning. Let's fill in the pieces so that you understand. So in 2008, a mysterious person who we still don't know, under the pseudonym of Satoshi Nakamoto, submitted a white paper with this concept for blockchain. He said, and the idea behind it was that we don't need to have a trusted government or private body that states this is real money, this is qualified money, but that we've built an infrastructure that allows participants to trust the system itself. As Luciana has explained, through the different steps, from mempool to transaction to these blocks being created, and this was a pretty next step. Like cryptographers had been thinking about this, but this was the first time that someone said, let's make a currency out of it. And so from there was born Bitcoin. And Bitcoin is about as Wild West as you can get. It is, nobody needs to know me. I don't need to know them. It's about the transaction. And in some ways it's a very appealing thing where you can say, I can maintain my privacy. I'm not losing my personal identity to, potential, fraudulent activity. The other side, the dark side of that is that you're like, oh, now I can do illegal activities and pay for them without people knowing. And as the use of Bitcoin started to kind of delve into those darker areas, that's what got the press. It was this idea that, oh, Bitcoin is inherently bad because it's private, nobody knows. And so you see something like Silk Road being, blown up. And one thing that is very interesting about this is Bitcoin is like a bank transaction. It's easy to follow because you have to validate the entire history of that particular currency for every transaction in order to create a new one. So you have this wealth of knowledge that just gives you a history of where that currency has been. So fast forward a few years, people are starting to get a feel for it. They're starting to get interested. And then 2017 rolls around and there's the ICO boom where suddenly every company, every tech company, every idea of a tech company has decided instead of doing an IPO, they're going to do funding through creating their own coin, an initial coin offering. And it's very exciting. People are very much putting a lot of money into it. Cryptocurrency in general just has this boom of money coming in. And that obviously, like the internet bubble bursts. Not every single company that has an ICO has a viable business plan as well. So you see kind of the collapse. And a lot of people start to take notice, and in particular, regulators start to take notice. As I'm sure any of you that are in a business that requires any kind of regulation or licensing, the more activity, the more money, the more regulators want to make sure that bad things aren't going on underneath the surface. So you get a lot of questions from the SEC, from FATF, which is an international organization that the U.S. is a participating country in. You get the IRS starts to say, well, how are we going to tax this if people are doing it? Is it currency? Is it a commodity? Is it, is it a stock? Like what are we doing? So you start to get a lot of noise in that. And 2018, 2019 is really kind of the flush out period where you say, okay, people are interested. That's great. It kind of collapsed. Is it a permanent collapse, or is this the sort of thing that we're going to see build up again? And as time has shown from 2018, 2019 into 2020, it has grown. And we're entering into this new phase, I like to call the institutionalization of crypto, where companies are taking notice, where, Dogecoin, which if you get nothing else from that very informative and very uninformative SNL skit, is that Dogecoin is the perfect example of a currency that has no other purpose than to trade. So what we have in essence had is we've created this new asset class. So it's no longer futures. It's no longer futures on a stock. It's now futures on cryptocurrency, and it's based on the perception of the value. And we run into that with GameStop, where you see a stock that is not worth the incredible boom that it had because everybody decided they wanted to make it worth something. That same basis is laid on cryptocurrency, which makes it more volatile. And I think that that's an important thing to recognize, is that Bitcoin has a long history, so there's some stability to it, and that's become the benchmark cryptocurrency. But it is a high risk. This is your emerging markets. This is your high value asset classes. So people are getting value out of it, but it is very much built on the asset classes stability overall. And we've also seen a lot of regulations just really stabilize and be surprisingly embracing of this idea. We had the OCC earlier in early 2021, late 2020, state that treasuries can now hold it. It's no longer this special purpose thing that you have to get a second license for, but you're starting to get some infrastructure and governmental and legal standing on it, which is giving a lot more room for companies like Square and Tesla to put it on their treasury. You've got PayPal and Square, saying not only do we want to use this as a way of holding value in our treasuries, but we want to give our customers the opportunity to hold and to transact through it. So that's kind of the picture right now, is we're very much in the growth phase where it's a technology that has been established. This technology is not going to go anywhere. If anything, it's going to be more infiltrated. Blockchain is going to be more in supply chains. It's, cryptocurrency is going to be used more in different types of payment types. And if we go to the next slide, let's actually talk about the different kinds of cryptocurrencies you can expect. So cryptocurrency, this is your Bitcoin, your Litecoin, your Ethereum. We'll talk more about Ethereum. But these are the ones where you say, okay, this is something that we have established within the network that we trust, and it is worth value because the community has decided that there's a store of value to it. And the larger the community becomes, the larger the population, the more stable that established price becomes. And so you've got that, and it's just strictly transactional. From there, you start to think, okay, well, we've got this fantastic technology that has decentralized a lot of this. Is there some way that we can put contracts in and, remove the need for people having to watch the timing of a thing? And that's when you start getting utilities where not only is it a store of not only is it a pathway of transaction that we've attached value to, but we can also time it. And we can also say, under these conditions, it will be executed. So it becomes this contract that, typically you have an executor, but now the executor is the technology itself. Filecoin and Uniswap are examples of this. And then you have security tokens. So this is the real world investment. So, this is if you wanted to have your mortgage on a blockchain, you can, instead of going to the you go to the office, the governmental office that keeps track of all of this, and you put it in there. That can be done on a blockchain. So your home is in essence tokenized. There is a token representing your ownership. It's a digital deed instead of a physical deed. And then you also have stablecoins. Stablecoins are probably the closest thing to real money that we have in blockchain in our traditional understanding. So what happens is you have whoever creates a stablecoin, they have a bank account with dollars. USD coin or USDC is the prime example at this point in the development of this technology in this market, where they create a USDC and they put $1 in a bank account. And the idea here is that it makes it very easy to track the value of it. It's pinned to the value of the US dollar. And then it also makes it easy. You've got a stable place that is still a digital currency that allows you to invest or not invest depending on particular volatility or trading perspectives. And then the final one, which is one that I'm sure we've all heard, and understand as well as I do are NFTs, non-fungible tokens. The idea here being, and at its pure sense, when you consider it from an art perspective, you're saying, how do we make digital art unique? I can buy a Picasso theoretically, because I can't buy a Picasso, but you can buy a Picasso and there are proofs on that paper, on that canvas that say this is an original Picasso. So it's worth paying that extra amount. Now I, in my current position, can buy a print and I can afford that, but I know that it's not the original Picasso. How do you do that with something that's code? There's no way of really distinguishing one code from another. So every print is going to be exactly like the original. What you can do is you can tie a cryptographic token, something that is unique in its very essence, and say this is a representation of the uniqueness of this thing. There will only be one NFT tied to this original piece of digital art. And that gives it some gravitas and some sellability within the market. So that is the whole spectrum of what we're dealing when we talk about tokens. All right, and now next slide. There are risks, and I'm going to try to tell a few war stories here to kind of bring it home. So cybersecurity, key management, wallet architecture, these are all things that probably don't mean much. So in 2015, I want to say, there was this giant crypto scandal in an exchange in Canada called Quadriga. Quadriga was it was one of the first exchanges where people could actually go on and they could trade cryptocurrencies. And it was just this great place. Everybody was really excited about it. And then the founder got sick in India on his honeymoon and died. And which is it's a terrible thing that happened. But additionally, he was the only one that had access to all of the customers' keys, because keys are, in essence, the token. It's how you sign this transaction and move it forward. So suddenly, all of this money just kind of disappeared. And, there was no backup plan. He may have had the keys stored somewhere. He may have had the passwords, in essence, the cryptographic passwords to get into these wallets, but it was gone. And so it's a major consideration. How do you keep your funds and your customer funds not only safe but accessible, because it is all digital, and you don't want to go around writing scraps of paper with these passwords and these keys for people to just pick up. So cybersecurity is a major concern from a asset itself, because it's a digital only asset. You don't have the backup. That's a concern. You also have data privacy. The more that you start to have people involved, and you need to have, KYC, know your customer blocks to prevent, illegal activity. You need to gather digital information from people. You're going to have images of their IDs. You're going to have their names, their dates of birth, their places of work. How do you keep that information safe? Which is very similar for any kind of digital banking platform. That same, how do we keep personal identifying information safe? So from here, let's actually jump to compliance. Know your customer. How do you not make Silk Road happen? Because if we're not diligent, if we're not watching these blocks, if we're not tracking people, then the illegal activity can continue to happen. You can have money laundering. You can have terrorist financing. So it's definitely a consideration when you don't ever have someone walk into your branch and have to sit down in front of you and hand you a copy of their ID. How do you ensure that this is the person that they say they are, that their activities are being tracked, that if you need to, you can report to law enforcement that activities are potentially suspicious? So you have to build in this piece. How do we keep this an above the board kind of currency, and how do we make sure our books aren't carrying these bad activities without realizing it? And then you have the financial piece. It's a volatile asset class, based very much on the comings and goings of the market itself. How do you, I'm sorry, did someone? Okay. How do you ensure that people are that your books are safe, that you're making wise decisions? How do you ensure asset liquidity while maintaining asset safety back to your cybersecurity? Because you don't want it all to be incredibly accessible to a single hacker. So you have a lot of options as to how you balance, the accessibility, the portfolio diversity, and things like that. You don't want to lose your shirt over something just because Elon Musk says that it's awesome. As fun as he is, it's a little terrifying that, maybe he's selling as you're buying what he's telling. Let's hope that's not happening, but you want to make sure you're making smart decisions. And then finally, the legal ramifications. We have a good decade of litigation that's starting to come along, which makes it a lot more stable to be able to make these claims, but chargebacks are not a capability for blockchain because it's immutable. They write it in the block, it's in the block. So you're going to have to find other ways to, have these kind of chargeback discussions, which if you're in a payments processor, you probably feel a little bit better about that. There's a lot of that kind of risk that you're avoiding, but you do have to establish how to keep that going well. How do you make sure that the transactions are private enough, without, really exposing yourself or your customer base to too much transparency? How do you avoid fraud or account takeover, things like that? So there's a lot to consider. All right, so next slide, please.
All right, and thank you so much, Shay. Just to wrap this all up so now you have a general understanding of blockchain, crypto, the different types of crypto assets that exist. It's not just cryptocurrency. There's many different ways to play within this space. Whether if it's cryptocurrency, accepting payments, or launching a utility token or security token or even an NFT, there's a different angle to crypto assets, all dependent on your business and your industry. So, with that, some of the things to think about is understanding all of these different options is what makes most sense for your business, even if and whether you even want to get involved. If you do, then how do you want to proceed? Do you want to build it in-house? We've had conversations with a number of different companies that we know that have done that. Or do you want to buy, and where that could be paying a sub-custodian such as Gemini to really perform those services, crypto asset custodies for you. Or a third option is always to partner with a professional services company such as KPMG to help you think through of your strategy and help you build your infrastructure. Can help you build your infrastructure to offer these crypto asset services and products. And then additionally is take a look at what the current regulations are. And make sure that your business is ready to abide and built in a way that you're abiding by these regulations and stress scalability. So take a look at your business, and if you have to hire today and start building out your crypto team, it's another area to start moving quickly on. With that, unless any of my other panelists have anything else to add, we'll be happy to take any questions.
So this is David. I've been monitoring the private chats. For those of you who haven't, if you have any questions, please throw it in the chat, and I'm monitoring these as we speak. So I'll throw out some of the questions. The first question, and it's a good one, it talks about places or examples or use cases where blockchain has been successful. I'm going to take one quick step back and again focus on both the idea of public blockchains where you have cryptocurrencies. There are semi-private ones which might be run by consortiums, and this can be in the ESG space. This can be in the authenticity of of a particular product space. And then there are private blockchains, as we covered, which are generally for enterprises. And it could be intercompany within an enterprise. So the transfer of goods from China to the US to the UK, for example, within a company, but also with stakeholders such as suppliers and customers. That would also be considered a private system. So let's talk about a couple of those, and then I'll throw out some of these other questions in the chat. If we take a look in the marketplace, there's a few interesting blockchain systems that have been put in place outside of cryptocurrency. The first one is Walmart. Walmart has created, first they started with a proof of concept where they said, if you're going to be selling spinach in our stores, we would like to know everything about that spinach from the moment it was planted in the soil it was planted, to when it was grown, to when it was picked, to when it was washed, bleached or not bleached, sanitized, packaged, and where it has gone. From there, Walmart has expanded that use case because it was so successful to include other vegetables and other fruits within their system. And they're now looking to expand to other meat products. And the thought is eventually, if you look at some of their analyst calls and some of the projections, to expand to anything on their shelves. So a great way that we can take a look at the provenance of anything that can be for salmonella poisoning, for example, health risk, etc. Another example is Louis Vuitton company has put in place for to deal with counterfeiting of its bags, Chanel bags, also different types of alcohol brands underneath its particular branding. So in those cases, blockchain allows for that authenticity to be stored in one place. Going into the financial sector side, and then we'll get to another question. Another great place is in financial sectors. There's two places we're seeing this. The first is within the country of Luxembourg, where folks generally trust the government. They are providing their digital identity to the government via a blockchain. That identity then can be used to take out any type of loan at any type of bank. It could be a personal loan, a home loan, a car loan, a business loan, whatever it may be, a credit card. And the thought is that your identity is protected by being stored in one system that any system can move on to. So there are some examples where it's being used. I'll look to my colleagues, but what some of the work we're doing around ESG and carbon, maybe one of you two would like to talk about some of that work if that's possible.
Yeah, I'd be happy to. So we have an initiative where we are trying to create an accounting infrastructure for climate. And the two areas we're focusing on right now are oil and gas and real estate. So how do you know that your natural gas is green natural gas? You know, there's an assumption that they have requirements that are indications that it's green natural gas. You know, certain amounts of like certain levels of mining. Sorry, I don't know a lot of the details as to like what the indicators are, but they have indicators that they have in theory digital proofs of. They've got some sensor somewhere that's indicating pressure levels are this, which indicates that. But how do you get that to the end user? How do you get that to, you know, the commodities markets? How do you get it to, if it goes far enough to your personal electric bill where it says, or your natural gas bill, where it says like, okay, this is green and it's verified here. What you can do is you can tie that information into a blockchain. And the appeal of the blockchain is that it doesn't have to be a coordination between different natural gas providers. Everybody just contributes to the single blockchain. And so the information is available to all participants. There are conditions and rules set that allow for these certifications to be continued or transacted. And then a similar concept for real estate. You know, how do you know that the building that you're leasing is actually green certified? You know, does the city have tokens that are credits that allow for certain amount of, you know, lead up time to becoming, you know, carbon neutral by 2040 or whatever it is the city or the company itself has indicated? You know, and this is a way to take this conceptual idea and this really good theoretical promise and actually account for it, and to take the data and to put it in a place where people can track it and understand it and be able to make gains on it and hold other people accountable for it.
Yeah. And I think something that I would add to that is where the crypto component really lies in that is that within KPMG's climate accounting infrastructure is that we are leveraging blockchain to really tokenize. And this is another term within crypto. I guess there's your coins and your tokens as well. Your tokenize or your carbon emissions or methane emissions with your building emissions essentially. And within those tokens, not only are you capturing your accurate emissions, but also performing analytics and identifying ways to improve your emissions and generate reports that demonstrate that you and your business, your buildings are compliant to today's regulations enforced by whether if it's the Paris Agreement, et cetera, and so many government regulations are in place that many executives and businesses are committed to meeting all of these. So essentially, what tokenization does is that you're it's digitizing. It's essentially, if you think of one ticket, it has all the information of that building, of how much you actually emitted, and all the information on where is that link to that report that proves that you are actually compliant to these regulations.
Let's bring it to the last two questions. Go ahead, please. I'm sorry.
Sure. Yeah. So, well, first of all, David, Luciana, Shantel, great overview. I think my mom would have understood about half of it, and that's pretty good, actually. So great job there. Good overview. So, two quick questions. One on maybe the cryptocurrency side, one on blockchain, and then we'll wrap. And rather than call it crypto, let's call it digital currency. So, and maybe David, this is for you. When does that become mainstream? I'll challenge you to predict a year, right? I mean, is it 10 years? Within 10 years, is it mainstream? And what has to be in place for that to happen? I mean, certainly needs to be able to store value, needs to be able to be universally accepted. Think through that for us a little bit.
Yeah, and I think looking at some of the other chat questions that were asked, we'll probably hit some of those at the same time. So I'm an economist by trade. So when we say it's funny money, or we joke about that on Saturday Night Live, initially I think it sort of became that to some ways, and unfortunately through some bad actors it did become that. Should governments step in and help, or should they be worried that they're going to be out of the scene? I think it is an either or, actually, myself, because again, the purpose of this is to remove intermediaries. Governments who maintain the currency are intermediaries by definition, whether it's the Federal Reserve Bank, the U.S. Treasury, or outside the United States. So the question is, do we need the Fed? Do we need the central banks to monitor our money? What needs to be put in place, in my opinion, and this is strictly in my opinion and in my view, one, we're going to have to be able to have the actual cryptocurrency or digital currency backed by a real asset. Okay, that real asset can be anything from money, gold, to housing, depending on what asset is being traded, or art. But at the end of the day, I believe there needs to be a tie to a real asset. Otherwise, it still just becomes a game of gambling. Furthermore, what needs to be grown up is the trust in the emerging technology, and that's only going to come with time. So presentations like this are just the beginning. How do we get the folks on this presentation who are watching this to understand that what we've talked about sounds scary, but perhaps it could actually change and transform the way we handle business itself? So all of those things need to come with time. And it's ironic that blockchain has been brought into place to decentralize the transactions and the data. But in some ways, we all do need to come together and agree upon a way that we're going to make those transactions occur via those contracts and agreements.
Very helpful. So still certainly a ways to go before we're using it ubiquitously in a retail opportunity, correct?
Yeah, I think that's exactly right.
Right. But clearly at some point, I mean, digital currencies will be a factor. And I'm sure at some point in the next generation, that's all they'll be using. So that path is going to be interesting. Second one, just on blockchain. And Dave, you did a great job of outlining some tangible examples, whether it was Walmart, whether it was Louis Vuitton, and you guys talked about banks and natural gas. Two parts of this question. So one, blockchain, I mean, it's revolutionary. Would you equate it to as revolutionary as the printing press or the steam engine or the microprocessor? Is it that big a deal? And my hunch is it is. And then secondly, how much investment are you seeing companies put to it now, and how will that ramp over the next 5 years?
I think the reality of this has two answers. There's the specific digital crypto side, where I think we've already covered that conversation and where we think that's going to go. On the enterprise side and how it can help companies and regulators and tax authorities and others actually communicate with each other. Imagine a world where I could promise you, and this is just an imagination here, that whether it's your supplier, your manufacturing plants, your distributors, your auditors, your tax authorities, your SEC regulators, all of them can speak to each other from a trusted ledger of information, where all of those systems actually validate information or reconcile it on the fly to prove from soup to nuts what's happened in any set of transactions. That's a real valuable thing to any organization. The last time we heard about that happening was around ERP systems, and that was strictly in the context of financial transactions, right? Or the transactions of the businesses. Blockchain has the ability to allow businesses to manage cash flow, manage their assets, manage how vaccines can get from point A to point B, and God forbid something happens at point B where something went wrong in between. That is what this technology can do. So I look at it as an enabling technology, a technology that allows consensus across stakeholders. And what it's going to come down to, though, is can we get stakeholders to trust that the technology won't give up sensitive information or private information? Can we work together and trust that that will not happen?
Well, some key things to keep an eye on then, certainly, and blockchain is certainly here to stay and is going to, in many respects, revolutionize a lot of things in the background. So, team, great overview. Thank you very much for taking the time. David, I know you were out and about and were able to redeploy and spend time with us today. And then certainly, Luciana and Shantel, thank you for bringing your expertise to us. Really well done.
It's been a pleasure. Thank you so much.
Thank you for the opportunity.
Absolutely. And I want to thank David Leiter as well for just getting us organized on that. David, thank you.